Coming up on today's episode, we're going to examine the stock market through the lens of the 11 S&P 500 sectors, who's leading, who's lagging, and what does it mean. Also coming up, Silicon Valley Bank has become the biggest U.S. bank failure in more than a decade. It's very Lehman-esque, and it follows Silvergate Bank, the cryptocurrency lender that went bust. More on that in a second. Let's take a look at the 11 S&P 500 industry sectors and the ETFs tracking them. And this is a table that illustrates what's going on. We've seen three sectors in positive territory since the beginning of the year, led by technology, XLK, XLC is communication services, and then XLY, consumer discretionary. And I consider all of these sectors more on the offensive side. And it's curious that they've been leading the way in terms of performance, especially since we are in a recession. Typically, you see the defensive industry sectors start to pick up steam. We haven't really seen that. One thing I will say, though, is we're starting to see less and less industry sectors within the S&P 500 in positive territory. You'll notice we got already 6 industry groups, beginning with real estate, XLRE, in negative territory. And, of course, the deepest losses, XLU, which is utilities, one of the most defensive industry groups. What's going on, Ron? Well, higher interest rates have put a damper on this particular industry sector. And again, I think the bigger overall picture, when you take a look at the S&P 500, we're starting to see that hot performance start to tail off. We're seeing less industry sectors in the green, and now we're starting to see some losses. Granted, they're modest losses. I mean, we're not yet in double digits, so nevertheless, we're starting to see, though, a deceleration of positive performance. This is what the stock market sectors are telling us. Again, this is the S&P 500, 11 industry sectors. This is also through the market close of March 10th. Let's take a look at this next chart. This is Silvergate Capital Corp. And Silicon Valley Bank. This is a pretty swift collapse for both companies. Silvergate was the crypto industry's hallowed institution. Shareholders at both companies are now facing a total wipeout. And, you know, it wasn't that long ago that crypto bulls were lecturing us. They, along with all those NFT experts and the 26-year-old children with Instagram accounts, they were lecturing us about, well, hey, financial contagion is only something that happens in the fiat money system. It only happens in the traditional banking system. It would never happen in the cryptocurrency market. The cryptocurrency market's too advanced for this to happen. Well, look at this chart. Wrong again. The cryptocurrency market is, in fact, very much a victim of contagion. And we see that in these two companies, these two institutions, which pretty much can kiss themselves goodbye. Also, we see the Wall Street Journal covering this quite closely, as many of the leading media outlets are doing. Silicon Valley Bank closed by regulators. FDIC has now taken control. There's a nice shot of Janet Yellen. She looks kind of stressed out. What do you think? And look at that subheading. Some tech startups have been rushing to transfer money out. Well, here's the problem, folks. Many of the bank's deposits are so big that they didn't carry FDIC protection. And according to SVB, that's Silicon Valley Bank, they estimated that there was over $151 billion in assets that were not covered or that exceeded FDIC insurance. So what is the lesson here for all of us? And I think it's worth repeating, because this is something I've been working on at ETF Guide. We've got our margin of safety tool, which is almost ready to be launched. And if you have not yet gone to etfguide.com and signed up, I encourage you to do that, because this right here is a perfect example of very sophisticated folks being sloppy with the implementation of their margin of safety. In this case, it applies to these startups, and they clearly had the right idea, but very, very poor execution. Too many of them were only insured up to $250,000. And everything above that, they were flying by the seat of their pants. So again, they had the right idea, keeping their money in a safe account. That's margin of safety. It applies to institutions. It applies at the individual level for investors. But you see that they had poor and sloppy execution by underinsuring their capital. And so what are the attributes for margin of safety assets? This is just a quick review to help re-educate you about this. So liquidity, zero volatility, and 100% principal protection. Not partial protection, full protection. When you have $1 million at a bank institution and only $250,000 of insurance, you're not fully protected, are you? And so this is one of the reasons why I'm reintroducing this margin of safety concept that Benjamin Graham introduced. He applied it to how investors pick individual securities. But his powerful message, his powerful concept applies to how an entire portfolio is managed, not just to how you pick securities. It's fundamental. Let's review this. Assets that do not meet the minimum standards of safety. Bonds, precious metals, real estate, cryptocurrencies. You know, they have all the same thing in common, right? They're not 100% liquid. They're not free from volatility. And there's no principal protection. These are not the types of assets you use for your margin of safety bucket. And here's a perfect example of that, 2022. All the 60-40 folks learned this the hard way, that bonds, as well as U.S. Treasuries, can and do lose value. And they cannot be relied upon when the equity market is falling, right? We were lectured that, when stocks rise, bonds, or stocks fall, bonds rise. Right? That inverse relationship. Well, most of the time it's an inverse relationship, but even so, bonds and U.S. Treasuries are not margin of safety assets because they can and do lose value and they fluctuate in value. So key takeaways for today's episode: only use investments that meet the minimum standard of safety for your portfolio. And that's, again, for your margin of safety bucket. Don't be sloppy with your implementation like all of these folks that had their money at Silicon Valley Bank. $151 billion has gone up in smoke, innocent capital, because of sloppy implementation. Let this be a lesson to all of you investors out there that, number one, have 100% of your assets at risk. Number two, you're using the wrong types of instruments for your margin of safety capital, your cushion. And number three, you've underinsured yourself. Again, bonds, precious metals, even money market funds do not meet the minimum standards of safety. Do I have to take you back to the 2008 financial crisis? Money market funds, one of the biggest busts that came before the Lehman crash, if I'm not mistaken, but it was somewhere in that vicinity, in that time zone or time period, was the Reserve Capital Fund. Look it up. It's on Wikipedia. They had, about $70 billion in assets? One of the most successful money market mutual funds of all time that people thought was safe. And they got nuclear bombed because, again, they made this fundamental mistake of using the wrong types of assets for margin of safety. Again, what are the minimum standards of safety? Number one, liquidity, zero market volatility, 100% principal protection. And that does it for today's program. I hope you've learned something. And be sure to go to etfguide.com. You can learn more about the margin of safety tool. Be sure to watch our other programs like ETF Battles, First Look ETF, and Portfolio Makeover. I'm Ron DeLegge with ETF Guide. Thanks for watching.